You are looking at the most dangerous inflation trap on the pound this month. UK CPI printed cooler across the board yesterday. Rate hike expectations collapsed, and naturally the pound should have tanked. Instead, pound sterling to US dollar just printed a strong buy signal on the 1-hour chart, right into a brick wall of resistance that could break the entire daily structure. There is one danger zone and one hidden opportunity today. I will show you both. Stay until the end because I am giving out 3 exact entry and exit levels you can use right now, and the invalidation number that will tell you if the pound is about to collapse or squeeze. Write this number down. 1.3469. That is the session invalidation level. If we break and hold above 1.3469 today, the strong sell bias on the daily chart is dead, and we shift to a neutral to bullish grind targeting 1.3550. Until then, the session bias is fade the rally, sell into strength, because the higher time frames are still bleeding lower, and the 1-hour strong buy is just a bear market retracement that is about to exhaust. The whole structure right now is range fading within a daily downtrend that respects the 200-day moving average as a floor but keeps getting capped by the 50-day and 20-day averages. If we break 1.3469, I will be wrong. I want you to hold me accountable. Write it down. Now let us walk the chart from the top down. On the weekly time frame, the trend is buy. That sounds alarming if you are bearish, but here is what the weekly buy really means. The week is still forming, and last week we saw a bounce off the 200-week moving average around 1.3350. That bounce is what is keeping the weekly structure from flipping sell. So the weekly buy is not a conviction long signal. It is a defense of the long-term bull trend that began last year, but it is now on life support. The weekly MACD is curling lower, and the price is well below the 50-week average near 1.37. That puts the weekly in a bearish retracement within a bigger bull. Exactly the kind of chop that produces violent mean reversion. If the weekly close this week pierces below 1.3341, the weekly trend flips to neutral, and you will hear every algorithm go short, drop to the daily chart. Strong sell. The daily trend is strong sell. The daily candle bodies are consistently closing below the 20-day moving average, which is now at 1.3460. That 20-day average is almost exactly confluent with the 50-day moving average at 1.3470. You have a ribbon of death forming, where the 20 and 50 are sloping down and pressing price lower every time it tries to breathe. The 100-day moving average is flat at 1.3452, adding a third layer of resistance inside a 25 pip zone between 1.3444 and 1.3469. That cluster is a brick wall. When price approaches that wall, sellers have stepped in relentlessly for the past week. The daily MACD is reading -001. Effectively at the zero line, on the verge of a fresh bear cross if momentum dips again. RSI is 47.7, no man's land, perfectly neutral, ready to tip either way. The daily chart is not bullish. It is a coil waiting to break. Now the 5-hour trend is neutral, confirming this as a consolidation zone. The 4-hour candles have been trapped between 1.3369 support and 1.3444 resistance. And here is where the trap becomes clear. The 1-hour chart just flipped strong buy, and the price is nudged above the 1-hour 200-period moving average at 1.3379, which also happens to be the daily 200-day moving average. That double floor status at the 200-day is the only thing keeping the pound from a free fall. The strong buy on the 1-hour suggests a short-term momentum burst toward the resistance cluster. But that burst is running straight into the daily strong sell pressure. When a lower time frame buy signal collides with a higher time frame sell wall, you get a liquidity vacuum. The short-term traders push it higher, the smart money absorbs the liquidity at resistance, and the reversal is faster than most people can react. My base case is that price tags 1.3444, maybe overshoots to 1.3469, prints a wick, and then reverses with force back toward the 200-day average at 1.3379 and possibly breaks it this time. Here is what most traders miss. The cross-asset linkage between pound sterling to US dollar and euro to US dollar is screaming divergence. While the pound is struggling below 1.34, the euro has been relatively stable, not because euro is strong, but because the dollar is not uniformly crushing everything. The US dollar index is stalling near its own resistance, and that is creating a false sense of security for cable. But the real killer is the UK bond spread. The 2-year UK gilt yield has collapsed relative to the German 2-year yield over the last 24 hours. That spread compression directly attacks the pound's rate advantage. The cooling UK inflation data, specifically core CPI dropping and services inflation easing, has taken a 50 basis point Bank of England hike off the table. The market is now pricing in a terminal rate much closer to 5.25%, with rate cuts potentially starting earlier in 2026. That repricing is the fundamental driver that will keep a lid on pound sterling to US dollar. As long as the UK yield advantage is shrinking, any rally in cable is a sale. The same dynamic is playing out in euro to pound sterling, which is breaking higher, confirming pound underperformance. If you see euro to pound sterling clear 0.8620, that is your cross-check that the pound collapse is accelerating. MY 1 to 2 week directional lean is bearish, targeting a breakdown below the 200-day moving average and a test of 1.3341 initially, then 1.3200. The event that invalidates this thesis is a daily close above 1.3469 combined with a DXY breakdown below 105. If that happens, the pound can squeeze back to 1.3600. Otherwise, the path of least resistance is down. Most people will skip this next part, but this is where money is made. Keep watching. I am giving you 3 trade setups, each with exact triggers, stops, and risk-reward logic. Strategy 1, the sniper. This is conservative, waiting for the price to fully engage the resistance cluster before committing. The trigger condition is a bearish rejection candle on the 4-hour chart at or very near 1.3469. I want to see a wick longer than the body, closing back below 1.3444, preferably with a bearish MACD cross on the 4-hour lining. Entry on that 4-hour close below 1.3444 after the rejection. Stop loss goes at 1.3510, above the psychological 1.35 and above last week's high. That gives a 41 pip stop. Target 1 is 1.3400, the round number and the midpoint of the current range. Target 2 is 1.3369, the daily support. Risk reward on target 1 is roughly 1 to 1.5, and target 2 is 1 to 2.4. If target 1 is hit, move stop to break even. What voids this setup? A 4-hour close above 1.3495 without a wick, or a sudden headline shock like an unexpected hawkish comment. That sniper setup lets the market confirm the rejection before you enter. Strategy 2, the active trader. This is a standard mean reversion fade for traders who can manage a tighter window. Entry condition is a pullback to 1.3444 that stalls, showing a lower high on the 1-hour RSI with price struggling to break the level. Enter short on a 1-hour close below 1.3430 after that stall, confirming the rejection. Stop loss at 1.3475, just above the 50-day moving average and the daily resistance cluster. That is a 45 pip stop. Target 1 is 1.3385, just above the 200-day moving average, where early profit taking will happen. Target 2 is 1.3341. The lower support and a level where I expect a strong reaction if we get there. Trailing stop rule. Once target 1 is reached, move the stop to entry and let the remainder run to target 2 with a 20 pip trailing stop on the 1-hour chart. This setup banks the bounce fade and then rides the breakdown if it materializes. Let us see how aligned we are. Type your pound sterling to US dollar range for tomorrow in the comments right now. I am reading them. Give me your high and low, and I will see if the community is too bullish or catching the trap. Strategy 3, the aggressor. This is high risk and only for those who know how to lose small and manage risk aggressively. This is the breakdown trade. Entry condition, a 1-hour close below the 200-day moving average at 1.3379, with volume spike and the 1-hour MACD crossing negative. Enter short on that close, no waiting. Stop loss at 1.3420, a 41 pip risk. Target 1 is 1.3341, the first support. Target 2 is 1.3300, a psychological level and the next structural floor. Risk reward is 1-to-1 on T1, 1-to-2.5 on T2. Explicit warning: this trade can whipsaw violently because the 200-day is heavily defended. If the break is a trap, the squeeze back above 1.3379 will be sharp. Only take this if you can accept the loss with no hesitation. Risk management pulse. Never risk more than 1 to 2% per trade. No positions through high-impact UK or US news. Stops are non-negotiable. Set them and trust them. The most critical level for the next session is 1.3469. That is the pivot. A 4-hour close above it and the daily bear thesis is compromised. Below it, sellers are in control, and every rally is a short opportunity. Tomorrow we have UK retail sales data and the US PMI flash, both of which will test the pound's conviction at these levels. If you want the full breakdown on Bitcoin and the S&P divergence, that video is live now. Check the end screen. Smash like if this analysis gave you a clear plan. Subscribe and hit the bell for daily coverage across all 8 assets. I will see you in the next one.